You are hearing the phrase often inflation is rising. The most current data from the research tank Center for Monitoring Indian Economy show that India's unemployment rate declined to 6.43% in September 2022, the lowest level since August 2018, and after reaching a 1 year high of 8.3% in August 2022. In the US, the Federal Reserve's monetary policies may be a factor in whether a recession will occur. With the looming threat of a recession, are people ready for what's to come? In this interview, I explore whether there's a real recession or a technical recession, how India reacted with COVID 19 dissipating, whether this was engineered by the US, whether inflation in India may be an engineered number, whether we can shake off this feeling of being recessionish, whether there's more reaction to noise than reality, how the stock markets may be getting affected, the outlook retail investors ought to have, and whether we are really talking ourselves into a recession and more. In our first interaction for Rising, I speak with Chakri Lokapriya, Managing Director, TCG Asset Management.
Well, Shirja, thank you so much for having me. It's indeed a pleasure, and I'm really honored that you chose me for your first interview. And you are rightfully amongst the top most influential women in India and Asia. And I truly believe that you do bring a lot to the table, and Rising will do really well under your leadership.
Thank you so much, Chakri. Thank you so much. Let's begin with what's really the chatter on the ground, especially in the finance and business circles. Of so many years of me covering and reporting about businesses, I have never seen there's so much of confusion about recession. I mean, is it a real recession or is it a technical recession? Why can't there be a unanimous view on recession this time around? Where is it that we are really lacking?
Shirja, that's a wonderful question. Now let's go back to a very simple 101 of economics. Usually a recession is when demand falters, people lose their jobs, and then therefore there is greater unemployment in the country. The country's tax reserves are going down, or rather the tax receipts are going down, and therefore the reserves are going down. And then the government and the central bank step in to then revive the economy. That is a textbook definition of a recession. On the other hand, when a demand is really very strong for an economy as a natural consequence of an economy doing really well, and a central bank wants to kind of slow it down or cool down the economy, then again, they start gradually increasing interest rates with a view to slow down the economy. So that's a textbook recession and a textbook slowing down as we all know it. Whereas this time around, we're coming out of a pandemic, the whole world, India included, for 2 years plus 2020, 2021, the country was under lockdown. Demand was very weak because people could not go out, factories could not function properly. And in 2022, the economies, as COVID kind of started receding, India started picking up. And therefore, demand was not strong, but supply was weak because companies were still not able to operate. And because of that, prices started moving up and not because of demand. This is the biggest difference between the current surge in prices versus the previous natural recessions.
Okay, so do you think it's more like an engineered recession by the US government? Can we say that much could have been done to avoid it, and now getting out of COVID situation, perhaps the risks have only doubled? What can you say about that?
That's a wonderful phrase that you've coined. Yes, it looks like an engineered recession in a sense. Today, you have the US dollar, which is the strongest currency in the world. If you look at it versus Japanese currency, French, German currency, they've all fallen anywhere between 15 to 25% in the last 1 year. Now, this does two things. One, from an US perspective, they are importing disinflation, because if the dollar is strong and if a good, a product, or a service is made outside the US and brought into the US, you need fewer dollars to buy that good or service. So which means a US consumer, while is feeling recession, it's not as much as other countries, especially if you look at Europe in a bad shape. India, recession, unemployment, what do you call interest rates are at the highest levels, and inflation is about 8%. So this 8% inflation in India is an engineered number simply because the US is increasing interest rates, which means the rest of the world has to follow. They cannot afford to not increase interest rates because the the real interest rate differential between two countries has to be at a certain parity levels. So which means as India is increasing interest rates to control a recession because of lack of supply rather than a stronger demand, the Fed is trying to engineer a recession, or in other words, kill a demand which is not there.
So, Doc, what happens then, Chakri? According to you, what should really be done? When I really talk about the public markets, are we seeing a disconnect in India? A lot of voices coming in say that India is on a strong ground right now because it's a very strong economy. The demand is there. We are inward looking. So this entire decoupling theory from the global economics, is it really true? The entire phrase that when the US sneezes, India will feel the cold. When China sneezes, India will feel the cold. How much decoupled can we really be, honestly?
Two things. One, over the last many years that I've been in the market, is very clear that there is no such thing as a medium-term decoupling of any economy. We're all interconnected. India has one of the biggest IT services. It exports to the US and to other parts of the world. So if they are in a problem, it's going to affect demand. Same thing for pharmaceutical, textiles. On the other hand, India imports oil. So if there is a recession worldwide, oil prices fall down. If the strong demand, oil prices go up. And if there's a recession, and it increases the fiscal deficit of India, which means the currency falls like it has been falling. And in that case, so therefore, these are examples that there's no such thing as a real decoupling of economies. Now, what happens is, in India's case, I think 80% of India's economy is domestic in nature. India is still, fortunately, a services economy. Nearly 70% is not a manufacturing economy, which is very unusual for an emerging country. Usually, emerging countries are all manufacturing intensive or commodity intensive or mining intensive. Whereas in India's case, it is services, which is usually the hallmark of an advanced nation like the US or the other countries. So against this whole backdrop, no, India cannot decouple. Already the IMF is cutting down the growth rates. It now stands at about 6% from about 7.5%. And that growth rate can fall even further, because if you look at today with an inflation at 8% and fixed deposits yielding about 7-odd%, the real interest rate, if a person invests money in a fixed deposit, after tax, the money does not actually make any income because of inflation. So which means the Indian economy can suffer if there is a global recession.
So what really are the chances of, if there is a global recession, are we in a recessionish kind of scenario right now? I don't think people are using the word being in a recession yet. The sentiment is recessionish for sure. There was a KPMG survey recently which posited that maximum CEOs are very confident that there will be a recession by the beginning or the middle of the year. That is a definite. What really is your stand there?
This is not a market that we want to be, but this is the market that we have. So we have to trade in the market that we have. So that is actually kind of reflected in what the CEOs are feeling, because at a micro level, the demand is still fairly strong in India. Companies are not seeing a recession in India, but with the Fed and other central banks talking so much about a coming recession, corporate India is now hesitant to do any capex, to do any expansion, because they're saying, hey, what if there is a recession? And then I do a capex, then it would strain the balance sheet. So let me hold back on my capex. Right now, demand is strong, but I don't want to really expand for the future. This is a very unusual place to be for corporates, because usually in a recession, what happens? They see slowing demand around them and readjust the company to slowing demand. Here, no, there is very strong demand. And they're saying that, look, there may be a recession, so let's readjust to that. So I think the consequence of all this is, therefore, earnings for the next year can slow down for the Nifty.
So there's more reaction to the noise rather than the reality. Can we say that from India Inc.? So while there is strong demand, there are more sort of reactions being done to the noise of recession. Is the noise of recession greater than the reality? Can we say that?
The noise of recession is clearly more than the real thing. And it's like almost like we are talking ourselves into a recession, which is not there. And so hopefully we don't get there, because fortunately the central bank in India is cognizant that growth can slow. They're cognizant that while they have to increase interest rates, they still have an eye on growth. So I think that way we have a fairly proactive central bank, which will probably do the right thing.
But this entire thing about the US engineering a recession, you think that is going to stop in the foreseeable future? Because all the commentary coming from the West sort of posits that the recession is happening, going to be there for sure. Yeah.
See, there are two things. One is, if you look at US is not in a recession by any stretch of imagination right now. The demand is very strong. The US consumer is very strong. 2/3 of the economy is consumer driven. Still, employment is very strong. People are finding jobs out there. So people are confident. All this is in the US. On the other hand, in Europe, because they're dependent on natural gas and oil from Russia and other parts, and Ukraine for food grains, and the supply is restricted, they are feeling the pinch of higher gas prices, shortage of food, and therefore the inflation there is more real. And also, mind you, the European currencies have created about 20%. India has actually fallen only about 9%. The reason I say only 9%, which is actually a very big number, is because the Japanese currency, the German currency, is down about 25%. So now, if you rewind back, the artificiality of this whole situation is, because US employment is so strong and consumer demand is so strong, they're sharply increasing their interest rates with a view to contain the demand. To keep up with them, other countries are increasing interest rates, and so they will go into a recession first rather than the US.
It's clearly a US engineered recession, looks like on the face of it, but perhaps artificiality of it is mind boggling. The noise is much more than reality. Let's talk about this entire impact on stock markets, Chakri, your day job, where you used to really dabble in. How is the noise impacting the stock market movement?
Two things. If you look at it from a foreign investment flow perspective, that has clearly slowed down. Simply because if the rupee has fallen 10% versus the dollar, then that eats into the investment returns that one makes. So today, an FII investor is, the Nifty, for instance, is negative year to date about 1%. On top of that, you add the currency fall, so which means an FII investor is down about minus 12%. So the foreign flows are clearly slowing down. So that has implications for the stock market and for the economy, because foreign exchange reserves into the country strengthens the rupee. If it strengthens the rupee, then the import bill comes down. If the import bill comes down, fiscal deficit is in a better shape, which means the economy is in a better shape. And usually when an economy is in a better shape, the stock market actually does better. So right now, and therefore the outlook is kind of sideways at this point because there is this huge readjustment process going on. Earnings are still estimated to grow anywhere between 8 to 12% for the next year. So the market is not expensive. And what is the uncertainty is how fast will it grow 8%? Will it actually grow faster? Or will it slow down further because of the war? I think it's this uncertain phase which will keep the markets very choppy rather than a clean lineup.
Okay, so the markets are sort of expected to be choppy. So this is the foreign institutional investors' perspective, Chakri. Now let's talk from a retail perspective. People who are salaried individuals investing in the market, and often the noise in the commentary can rile them up, can make them extremely nervous. In those scenarios where you are allocating a significant portion of your salaried wealth into the stock market, how would you be approaching the markets at this time?
I think the retail investor in India is well advised to make it a staggered investment, or rather what the mutual fund industry calls a SIP. And the high net worths also stagger their investment. The reason being, in a choppy market, because you don't know what's a high, what's a low, and you stagger your investments, you average it out. Fortunately, thus far, whether it's the Nifty or the mid cap or the multi cap, they are all down only about flat to minus 3 or 4% for the year. And in some of the more specialized funds are probably down 5 or 7%. So they're actually not down much, because as and when the situation eases, they'll very quickly catch up and move up. So versus a 20% plus return in 2021 and in 2020, the retail investor is still fine. So I think that's the approach, because fixed income really is not going to make a real return for a retail investor after taxes, because pre-taxes return is about, let's say, 7%. You knock off another 2 or 3% because of taxes, then you're left with about a 4% return. With inflation at 8%, which means you're actually losing by keeping money in the bank. So then where else do you keep it?
So you're actually losing money by keeping money in the bank. And the question arises, where else do you keep it?